Shall we start, sir?
Yes.
Okay. So, good morning to all. It's a bright and pleasant morning here in Coimbatore. Hope it's the same here in Mumbai.
Yeah.
Mumbai is limping back to normalcy, I believe.
Yes, it is.
Capital of the country. Yes,
Yeah.
it's great to have you, Shrikant, sir, for this session.
Thank you.
So welcome all the participants who have joined me from various parts of the country. So welcome to DJAM and to the training session on commodity derivatives in association with Multi-Commodity Exchange Mumbai. DJ Academy for Managerial Excellence was established in the year 2001 by late Dr. Jayavardhana Velu, who is the past chairman of Lakshmi Mission Work Limited, and DJAM aspires to be a destination of choice for the brightest minds from all over India and abroad. So learning never exhausts mind. That's what Da Vinci said. So sticking to our goals of continuous learning, we organize various programs for students, for faculty members, for working professionals. And so today we have one such program in understanding the nuances of commodity derivatives trading. We have with us Mr. Shrikant Koundinya, FCMA, CGMA, who is a fellow member of the Chartered Institute of Management Accountants. And he has around 25 years of diverse experience in finance and capital market, especially in the areas such as audit, research, ERP, MIS, and corporate training. He has a good insight to operations in organized exchange traded markets. In the past, he has been involved in imparting knowledge to regulators in India and abroad and has taken up various assignments with world agencies too. Mr. Shrikant, who has lived and worked in Africa and UK, has over a decade of experience in the commodity space and currently leads the training and education function at the Multi-Commodity Exchange. So we're extremely fortunate to have you with us today. And thank you very much for accepting our invite and joining in. And it's over to you, sir.
Thank you.
Just get a lot of insights about commodity trading and commodity derivatives, especially from you, sir. Over to you. Thank you very much.
Thank you. So I'll just be sharing a screen and then I'll get going.
So you can...
Yes, sir. You have that.
Thank you.
Welcome, sir.
Right. So good morning to everyone and all. This particular session on commodity markets, many of you might think it is something different from the audit. But I just want to let you all know right at the outset, even before I start, that commodities is something that is very, very close to each one of us. Okay, that means that every time you go and buy anything, now of course right now you're not going out, I presume, but even if you order online, whatever you're buying has got an element of a commodity and raw material built into it. Okay, so for example, if you're buying a mobile, so it has got a chip, it has got some electricals, it has got a bit of those little shiny dots which are silver, it has got plastics, and it has got all kinds of things which go into making of a mobile, right? Similarly, when you had breakfast in the morning, whatever you ate, it comes from the basic commodity and agriculture commodity. So the point here is that every time you go to a shop to buy something, somebody is keeping a tab on what you're buying because they will need to order a raw material to manufacture the end product that you're buying. Okay, so in point of what I'm trying to just basically say to you is that don't look at commodities as something which is absolutely different. It is something that you're all very familiar with. You can't live without commodities, and as we go along, it'll become much more apparent as to what I'm trying to say. Now, we have a very nice understanding with DJAM, the institute, and we have even got an MOU with them now, and we will be doing lots more programs of this nature in the future too. So this one is about creating a general awareness. And by the way, this program, the fact that this program is happening it goes and gets reported right up to SEBI. SEBI is the regulator for the commodity markets. And every time we do programs such as this to educate the market, educate students, we inform the regulators. This kind of programs are being conducted across the country to educate people. Yeah. Okay. So this is my first slide. I'm sure that those of you who are studying finance or have a bit of a finance background must be familiar with something similar to this. You can see that these are all different asset classes. We call them asset classes: capital, debt, currency, commodity, money market. These are all asset classes, and they normally form part of your curricula when you're studying. Okay. Now, do remember that if you are doing a higher degree, maybe the point here is that you're studying, and then one day you'll be in employment. Right now, you might be studying in a compartmentalized manner, but in reality, when you come into the real world, when you start working, you will find that all these markets are interrelated. Okay. Now, capital market is where you're looking at the stocks, the stock market, debt market, the bond market. You're looking at the capital market, NSE, BSE. That is where we think of the first thing that comes to mind. You got a debt market as well. Yeah. So a debt market is something to do with interest rates. You got a currency market. You got a rupee, dollar, rupee, yen, rupee, euro, or you can even have some other cross currencies like yen, dollar, or a euro, pound sterling, and so on. So there's a big market there as well, called the currency market. That's a currency asset class. And the one in red is where we are right now, what we're talking about, commodity markets. Now, I want you to understand a couple of things here. Number one, almost 85% of the commodities which are traded on exchanges such as ours, their price is in US dollars. Okay, so in other words, the price is in US dollars, and we in India, we convert the price into rupee terms, and the trading begins in rupees in India. Okay, and that is why we need to understand the linkages. When we talk on the debt market is about the underlying is interest rates, and especially interest rates in America and interest rates in India. The reason why America is because most commodities in international markets, they are priced in dollars and not in any other currency. So we're looking at dollar, and hence any change in interest rates in America. When I talk about interest rates, it's a debt market. So when interest rates change in America, they have an impact on the rupee dollar exchange rate. Okay, simple as that. If interest rates in America come down, then the dollar tends to weaken. And if interest rates in America goes up, then the rupee. Yeah, okay. So there is that relationship between debt market, interest rates, and the currency. Now, because most of the currencies are priced in dollars, when dollar becomes strong, then it has an impact on commodity prices. And that is an inverse correlation, meaning when dollar becomes strong, commodity prices in dollar terms tends to weaken. Okay, so if you have a strong dollar, commodity prices in dollars is weak. And when dollar weakens, commodity prices tends to strengthen. Okay, so that is one relationship there. Money market is just I just put it there because it's part of the financial markets. It is also it's another asset class, but it is a subset of our debt market. But capital market, now capital market is your stock market. So what many times happens is that people abroad think that India is a good destination to put money. So a lot of money comes into the stock markets into India. Or sometimes you find that the rating of India can go down and up, and sometimes you find the rating has gone down, and people will remove their money from the Indian stock markets and they'll take it abroad. Now the point here is that every time money comes in and goes out, it has an impact on the rupee dollar valuation. If money comes in, the rupee becomes stronger. If money goes out, rupee becomes weak. Okay, vis-a-vis the dollar, and hence it has an impact on the commodity prices, because every time it's a strong rupee, then I need less rupees to buy the commodity. If it's a weak rupee, then I have to pay more rupees to buy the dollar, to buy the commodity. Yeah, and hence this is a very important slide. You must remember this, and nothing changes here. All you need to understand is that in reality, in real life, everyone who is trading on commodity, any of the markets, they need to keep an understanding. They should have an understanding of all the asset classes and their interrelationships. Now, this is a very interesting slide, a very important slide of mine, because I always feel very satisfied once I've gone through this particular slide. Right now, you can only see colors. Yeah, so let's go one at a time. So what is traded on a commodity exchange? Okay, now most people say, hey, commodity exchange, it has to be commodities, right? But we do not trade commodities on commodity exchanges. So what is traded on a commodity exchange? We trade commodity contracts. Okay, so I want this differentiation to come in your mind. What is traded on an exchange is a contract. It's a commodity contract. Okay, and not an actual commodity. Now, what type of a contract do we trade on a commodity exchange? We trade derivative contracts, called examples of futures and options. So what are futures and options in one single word? Futures and options are derivatives. Okay, they're contracts. Okay, so what exactly is a derivative? Because a lot of people have this little bit of a fright when they come across words like derivatives. Nothing really to be worried about, because every subject matter expert wants his subject to be viewed as something really sophisticated. So they bring in these little difficult words there, frighten the people away. It happens in pharma industry. Just have to look at the medicines and look at the names. Oh my God, they're so long, you can't even pronounce it unless you're from that particular industry. Now, the same thing in derivatives. What really is a derivative? In two words, a derivative is a financial instrument. Okay, I'm sure many of you might have studied financial instruments as a subject matter. Yeah, so what are derivatives? Financial instruments. What is a financial instrument? So when you ask this question, what is a financial instrument, then we break up financial instruments. That's the best way of understanding financial instruments. You break them up by example. Yeah, so we break them into cash financial instrument and derivative financial instrument. Okay, now cash financial instruments examples would be cash which is in your pockets. It could be checks that you write, draft that you take, loans that you're taking, bills of payment, promissory notes, yeah, mortgages. These are all examples of shares. These are all examples of cash financial instruments. They're called cash financial instruments because their value is very apparent. 100 rupee note says 100 rupees on it. Yeah, so you know the value. So in a cash financial instrument, you know the value. Okay. Now comes the derivative financial instrument, which is where I need to ensure that you're listening here. Yeah. What is a derivative financial instrument? Okay. Derivative financial instruments have got three characteristics. Once you understand these three characteristics, you will never ever have any problem with understanding a derivative. Derivative financial instruments have three characteristics. The first one is it is a value in the future, at a future point in time. That is all. Decided by me now. Yeah, not today. It is decided by me now. And that value that I decide will keep changing every minute, depending on all the information that I'm getting regarding that commodity. So for example, let's break it down again. So suppose I tell you that the price of gold in the market today is 52,000 rupees for 10 grams. Yeah, the price of gold today, 52,000 rupees for 10 grams. Suppose that is the price today. Now I ask you, how much are you willing to pay for gold in the month of December? We are sitting here in September. Now I'm asking you, how much are you willing to buy gold for? At what price? In the month of December. Today's price is 52,000. Okay, so a derivative instrument allows you, by way of a contract, through a contract, to buy gold in December now at a price that you think is going to be the price. Now, you may be right, you may be wrong, but whatever your instincts are that what the price is going to be, the instrument is there for you to buy. But if you're buying, always remember that whenever you're buying, someone is selling. Yeah, so it's all both the sides. So if I'm sell, I can also, just like I can buy a contract, I can also sell a contract. So I can sell gold right now in December, now at a price that I think could be the price. Okay, and someone might be buying it at that point. All right, and I'm just giving an example of gold, but we can do it for many, many commodities, and I'll talk about that in a while. Now, the second characteristic of a derivative. When I buy or sell something in the future, I don't need to pay all the money now. Now, if I had to pay all the money now, then I might as well go to the market and buy it. But because I'm buying in the future, which means that I will get delivery of the commodity in the future. And hence, I will not pay all the money now. Right now, I only pay a small amount of money. That small amount of money that I pay now is in the futures, commodity futures. Futures is an instrument, yeah? In the futures, we call that margin money. In options, in options, we call that premium, okay? So in derivatives, when I buy something, I pay a small amount of money. How small is small? It can be anywhere from 2% to 10%. Yeah, it can be any, but it is a much smaller amount of the total. Okay, so that's the second characteristic of a derivative. The final characteristic of a derivative is that at the end of the contract, because the contract would be a December contract, and it has to be very specific. It has to be like 31st December contract. Even that is not specific. It has to be 11:55 p.m. 31st December contract. Now I'm specific. Okay, so on that date and after that hour, I can opt for taking physical delivery. Okay, so in a commodity derivative market, I can buy contracts in the future. I can buy futures contracts, I can buy options contracts. So what are futures and options? They're instruments. Just like in the cash financial instruments, you have examples like cash, checks, deposits, loans, mortgages, shares. Like that, on the derivative side, the instruments are futures, options, forwards, swaps. What are the characteristics? Derivatives, one, I can buy or sell in the future at a price that I think is going to be the price now. Number two, when I get into that contract, I pay only a small amount of money. Margin is called margin money in futures. It is called premium in options. In swaps and forwards, we normally call them commission, the small amount of money. And the final characteristic of a derivative, all derivatives come to an end on the contract date. And on the contract date, the contract is settled either by give and take of the commodity in physical form or cash settling the commodity price. That means I buy today at a price, and whatever the price exists in the spot market on the 31st of December, at that price, right? At that price is important because that price and the price at which I've entered today, the difference between the two could be my profit or it could be my loss. Okay. Or I can just hang on right up to the end and say, hey, we have agreed on the price. Now give me the goods, and someone will have to give you the goods. Okay. Now the question now is, why do we require commodity contracts? Why do we require commodity contracts? Now, we can't wake up in the morning and say, let me start an exchange. You can't do that. It's the government which gives permission via the regulator to somebody to set up an exchange. Okay. Now, why has the permission been given for people to set up an exchange? It is there for people to do two things. So commodity exchanges are there so that people can trade in commodity contracts. Why? Because they can do two things. One is they can manage risk. What is risk? Price risk. Price risk is the risk that I'm anticipating due to changes that are taking place in the environment between today and the contract date. So for example, if I am a cotton farmer, then I'm anticipating that there might be less demand for cotton in December, and hence the price will fall. Or I might be a textile manufacturer, And I might be worried that there might be a shortage of cotton in the market, and I may have to pay a higher price to buy the raw material. And this logic applies to every commodity. And the other one is price discovery, which means because many people are trading on a commodity exchange, the price that comes out of that trading is called a discovered price. Okay. Now, where exactly are prices discovered? Prices are always, remember this, prices are always discovered where there's lots of buyers and lots of sellers. So we're basically coming down to something that you very, very basic, demand and supply. Wherever you have the highest demand and the highest supply, that market throws out a price. And that is known as a discovered price. And hence you can see this world map. Now you can see that a lot of exchanges in the world. Now, every exchange seems to have something special. The speciality is because they attract the number of buyers and sellers. So for instance, if I were to tell you the price of gold, now question is, where is the price of gold coming from? Now it is coming from CME, Chicago Mercantile Exchange. Why CME? Because CME has a maximum number of buyers and maximum number of sellers. Similarly, when I talk about crude oil, I look at NYMEX, New York Mercantile Exchange, for a particular grade of crude oil called WTI. Why WTI? Why NYMEX? By the way, WTI is an American grade crude oil. Now, why NYMEX? Because for trading of crude oil in WTI, the maximum number of buyers and sellers are trading on NYMEX. Similarly, Brent crude is at ICE Exchange. What is LME? Is another important exchange, the London Metal Exchange, where all base metals, zinc, lead, tin, aluminium, copper, nickel, all these are traded. They're traded in other exchanges as well, but LME is the exchange which attracts the maximum number of buyers and maximum number of sellers. And hence the price discovery is taking place there. What is LME? London Metal Exchange. Similarly, you have LIFE. LIFE or LIFE as many call it. This is another exchange where you find a lot of trading, the price discovery for things like coffee. Coffee is again a very important world commodity. People are buying and selling coffee. ICE Exchange, again, cotton prices. So India is the largest producer of cotton. We are number one sometimes, and sometimes China is number one in production of cotton. However, the price of cotton is discovered on ICE Exchange. And similarly, there are, if you look at the exchanges, like the TOCOM is a Tokyo Commodity Exchange, where price of kerosene and jet fuel are discovered on the TOCOM. The Chinese exchanges where all the soya seeds, soya oil, soya cake, everything to do with soya. Now Chinese and soya, I suppose you know the link. Now all those prices are coming from the Chinese exchanges because that's where the maximum trading takes place. Okay. Now, why I'm spending so much time here is because we are all in the lockdown. And what is common to all these commodity exchanges? They all have websites. Okay, so sitting at home, you can go and check out the website. There's a plethora of information there for you, for each one of you. You can take a commodity and read up as much as you can. And a good starting point would be MCX, which is the largest exchange in India. Okay, so there's so many exchanges. In India, we have 5 exchanges, commodity exchanges. There are 5 commodity exchanges in India. So there are lots of exchanges, all have websites. And once you understand the logic and the working of one exchange, then it is almost a 10-page job across the world. All exchanges work in a similar fashion. All of them have futures and options instruments, and they are very good employable, good employers around the world. So if anyone has any ideas about going across, working abroad, then remember that once you understand the workings of one exchange, you have opened up a Pandora's box as far as employment or employability is concerned. Now, when you talk about commodities, the question is, what impacts commodity prices? Okay, so many of these things I've already explained to you. For example, one is the ruling prices in international markets. That has an impact on prices in India. Okay, currency rates has an impact. We already explained to you that when this exchange rate fluctuates, there's an impact on prices. Politics, geopolitics has an impact on commodity prices. Sometimes you'll find in the Middle East, there's a problem, war-like situation, and then you find there's a crude oil prices start going up. And things like that. Sometimes we have seen that recently in a couple of months ago, the prices of copper and zinc, they collapsed. And then because the prices were so low that some mines, because you mine zinc and copper from the earth. So some mines in Peru, zinc mines in Peru, copper mines in Chile, in South America, they closed their mines because it was not viable for them to continue mining. And hence, sometimes lots of international events also have an impact on pricing, because if suddenly there's a prices collapse, then people stop producing, then they create a shortage and the price starts going up again and so on. Everything boils down to demand and supply finally, Trade policy and regulations like barriers, trade barriers. For instance, we are barring or we are stopping imports lots of commodities from China right now, and hence that will have a small impact for a short duration. There might be an impact on that, on prices in India of certain raw materials which are used to manufacture the final product, or you might be exporting something to China, and there's a problem right now with them, and hence there might be an exporter might have a lot of problems because he will have to find an alternative buyer or alternative purchaser, right? So, and sometimes the government also brings in quotas and restrictions and barriers because the government wants to help the local Indian farmers or corporates. Economic factors, recessions and inflation and all that has an impact. For example, when the government of India has recently, you must have heard about that 20,000 crores, I think 20,000 lakh or something of amount of money which the government is trying to pump in to bolster the SMEs. But what that would do eventually is, of course, it will help those industries, but it will bring in lots of money into the economy, which might also end up creating an inflation-like situation. But the government is spending that money because it wants to help. It wants to help the manufacturing sector. And hence, there are lots of things which has an impact. So the value of money changes, and with the result, it has an impact on prices. And of course, there are commodity-specific events, which affect. Like I sometimes you have something like a pink ball worm, which is a worm which attacks crops, especially the cotton crops. Sometimes you have a commodities or some event, such as 2 years ago we saw lots of unseasonal rain in Kerala, which had an impact on cardamom. Cardamom. There was suddenly lots of cardamom. Farmers suffered because of that insistent heavy rains, which destroyed the crops. Inventory levels also have impact. If you have too much inventory, then prices go down. If you have less inventory, prices go up. But what is the most important is when you're talking about factors affecting a commodity price, what I put up here is a very general list, but you have to pick up a single commodity and say, hey, what can impact the price of this particular commodity? But there's one factor which I have not talked as yet, but I'm sure we are all aware of, and which is the reason we are all on Zoom right now, and that is COVID-19. And COVID-19 has an impact on commodity prices. Okay, so we will see what it has done. COVID-19 has stopped people going out. Okay, so because of the lockdowns across the world, just take India for example. We produce 5.5 million car tires. Tires for the cars. India produces 5.5 million tires. But now we are opening up, but otherwise we have that the consumption of tires has come down drastically. So you can imagine what is happening to the two sectors. One is the tire manufacturers, and the other one is the natural rubber plantation owners. They're impacted by COVID-19. Similarly, because of travel, which has got restricted, many airline industries have shut shop around the world. We have also seen people are not going on holidays. Hotel industry is suffering. Cardamom farmers are suffering because of that, because there's no sale of cardamom, because cardamom is used in the food business, and the hotel industry is in the doldrums because although people are eating at home, but a lot of consumption which takes place in hotels has come to a standstill. A lot of cardamom gets exported from India to Middle East, and in Middle East also they're having a problem because many industries are closing down there. A lot of people are having problems. Some people are not going out and spending lavishly like they normally do. Perhaps now they're cutting down on eating out, and hence there's all kinds of industries suffer because of that. Okay, now events which are important to commodity markets. So you can see on the side here, I've put something here. I've said these events will have an impact on prices or rates. For example, whatever is happening today in COVID-19 has an impact on exchange rates. It has an impact on interest rates. It's being lowered by governments across the world because they want people to borrow money and help with the economy. It has impacted stock prices, yeah, and also we are seeing impact on commodity prices as well. So events, what are these events that I'm talking about? I'm talking about elections in the US in October. Okay, these are events which will have an impact. It will have an impact on exchange rates, have an impact on stock prices, will have an impact on commodity prices. Lockdown exit strategies will have exactly the same impact on commodity prices, and so will new supply chains because of tensions. Yeah, I'm sure you must have heard recently about 2 weeks ago when India, I think Australia, Japan, they're trying to form their own bit of a small group and creating their own new supply chain. So because they're anticipating problems from taking delivery from China. And hence, the minute there's a new supply chain, it either two things can happen there. Either price, you might end up with better pricing because you might get a better supply point, or it might be worse off. You might be worse off, which whatever the rate, whatever the implication, it will have an impact on commodity prices. Yeah, belligerence of China, geopolitics has an impact. Yeah, so these are some of the important events that you have to keep a lookout at. Efforts to bolster economies, I've already mentioned that. Interest rates, we're gonna see I'm sure we will see further weakening of interest rates across the globe by end of this year or perhaps beginning of next year, because all governments will be busy trying to bring their economies back online. And one of the way of doing that is you play around with the monetary policies, reduce the interest rates. Now, when you come to commodities, okay, I've already said everything is impacted by commodities, and commodities are impacted by so many things and so on. But the point of the matter is that when I'm looking at commodities, I need to know what am I talking about. Commodity is a very loose word. If I want to be more specific, I can break it down into saying agriculture commodities, base metals, energy, bullion. So what I've done, I've segmented it. Okay. Now within agriculture, I can segment it further. Yeah. So I can break down agriculture commodities further. I can say we can have in agriculture, we can have cash crops like rice and wheat, yeah, barley. They're all cash crops. In agriculture, we can also have spices like cardamom, mentha, turmeric, yeah, mustard. So there's a different industry altogether. We also have in agriculture, we can break it down into plantation crops. Yeah, plantation crops would be coffee, yeah, crude palm oil, yeah, natural rubber. These are plantation crops. And then we also have these commodities, oil seed, we call it. So you know when you go to a shop, like you have these little pouches of oil that are used for cooking. Yeah. Now these pouches of oil can be different sources of oil. The oil seed. So that itself is a separate big industry. So you can have a mustard oil, sunflower oil, soya oil. Yeah. You can do groundnut oil. You can just think of it. Just think of the shop. Think of your Kinara shop. Your grocery, and you'll just remember all the different kinds of oils which are available. Olive oil. All these are again coming under the agri segment. So agri segment can be further divided into these four classes that I just mentioned. Base metal. These are non-ferrous base metal like zinc, lead, tin, copper, aluminium, nickel. Yeah, I'm sure each one of you has used a bit of nickel this morning. Nickel. You can't make stainless steel. I'm sure you might have used a spoon somewhere if you have had a cup of tea or coffee, or you might have used a stainless steel plate, but you cannot make a stainless steel without nickel. Yeah? So nickel is one ingredient in the making of steel. So just to give you an idea that how how closely you're connected with commodities. If you have used a vehicle today, then you might have used a natural gas, which has come from the energy segment, or you might have used a diesel or petrol, which has come from from the energy segment. You've got a bullion segment, which is zinc, which is basically consists of gold and silver, platinum and palladium. Yeah, in India we don't trade on platinum and palladium, but we do have gold and silver. We're a big. India is one of the largest importers of the bullion segment. We import a lot of gold into the country. There are something called intangible commodities as well, like weather, but we don't trade in India in weather. But in the international markets, they can buy weather. Yeah, they can buy temperature. You can buy a temperature. And remember, you're buying derivatives. You're buying in the future. You can buy temperature in the future. If you're buying it, what does it mean? It means somebody is selling temperature to you. So there's a big market there for weather. You in fact have an exchange called the Chicago Climatic Exchange. Yeah, Chicago Climate Exchange. It's called a Chicago Climatic Exchange, and there's a European Climatic Exchange, and there is a Tokyo Climatic Exchange. So these exchanges are there where you can trade in temperature. You have freight. Freight, what is freight? Empty space in these little, on ships. So you can buy this space in the future. So after I'm sitting in September and I can buy an empty tanker or a empty container in December. I can buy it now. Why am I buying it then? Why do I need it? I need it because I probably want to export something. So I'm buying the empty space now, and subsequently I'll take delivery by using that space, and I'll export something in that. So there's a whole trading that takes place, a whole lot of trading that takes place in something called freight futures. Yeah, so there's freight futures, and there's an exchange there, Baltic Exchange. So there's a Baltic Exchange where freight gets traded. Similarly, there's electricity. There's electricity exchange. There's an electricity exchange as well. You can buy and sell electricity futures. Now, the futures contracts in electricity, they are at the moment in the OTC market. They're not in the exchange traded market, but they're coming. It's just a matter of time. So within the next 6 months, you will see electricity future contracts. So when you talk about commodities, what really are commodities? They're basically raw materials. The raw materials used, you require them so that you have a good lifestyle, you have a good life. So you have raw materials which are used to make the final product. Okay, and many a times these raw materials becomes input. So some of you might be investors in the stock market, and if you have an investment in a stock which is from the manufacturing segment, then the performance of that stock will depend on how efficiently and effectively the company has managed to procure the raw material to produce the final product, and whose sale will eventually have an impact on the bottom line, will make the share price go up or make the company give you a dividend. Yeah, so inputs in the production of other goods. So you can see how they're all connected very, very closely. And of course, remember one thing, when you're buying on a commodity exchange, you're buying contracts. I'm buying future contracts. And hence, when I'm buying a contract, I need to price it. I cannot price it unless I know the quality that I'm buying. So if I ask you, how much are you willing to pay for gold in the month of December? Then the next question the question that you should be asking me is, what gold? Is it a 50% pure gold, 90% pure gold, 95% pure gold, 99% pure gold? What gold? So the point of the matter is that whenever you trade a commodity, you need to know the quality, and that quality must be homogeneous quality, because thousands and thousands of people are paying trading on that contract, and the commodity that you're buying has to be homogeneous. So you must have come across that word homogeneous when you studied microeconomics perfect competition. One of the factors is homogeneity. That is, it is a standardized contract, standardized quality, because unless you have a standardized quality, you will not be able to price it. And hence, on a commodity exchange, when you're buying contracts, they are contracts for raw materials which have a standardized quality, and hence the word homogeneous. Okay, so this is about your commodity derivative system. So we have a commodity exchange right there in the middle, and you got lots of people who are trading on the commodity exchange. Who are these people? They can be farmers, and they can be corporates, and they can be wholesalers, importers, exporters, processors, traders, government, and individuals as well. So all these guys are coming to the commodity exchange and trading on the commodity exchange. Many of them are hedgers. They're trying to minimize their price risk. Many of them are speculators who are trying to make money. Yeah. But when the contract ends, on the day when a contract ends, on that day, you cross this gray line there, this line in the middle. You cross that line and you're in the physical market. Physical market is where you will be given the physical delivery of the goods, or this is a place where you will give the physical delivery to somebody who is buying. Yeah. So there, where are you giving the physical delivery? It can be at the warehouse. It can be in a vault. Vaults are used for the bullion segment. And for other commodities, you have warehouses. But when you give a commodity as a delivery to the warehouse, there has to be someone there who's checking the quality. Someone has to ascertain that the quality that you have delivered matches the quality promised on the contract. And there are lots of people there too. And hence the total commodity ecosystem, it creates employment. It creates something like about almost 10 million people employed in the commodity markets. So you've got traders and farmers, you've got quality checkers, you've got quality control. So in this entire area, the CCRL and Commerce, this I'll explain to you later. But the point is, I want you to understand that what is happening on an exchange like MCX, you're trading. What are you trading? You're trading derivatives. What are derivatives? Financial instruments. But when the contract comes to an end, then you cross the line and you go into the physical market. Okay. So now, I think now it should be very clear. So we have two markets. One is a spot market. Spot market is where I pay money and I buy the goods. Yeah, I can walk in, pay money, and take delivery. Yeah, in India, the spot market, we normally say that a spot market trade should conclude within 11 days. Within 11 days, you should have a conclusion of a trade. Generally speaking, that's a spot market, unless there's some contrary agreement which says that I will pay back money after 3 months. Otherwise, everything should happen within 11 days. On the other side, I have a derivative market as linked to an exchange like MCX. So on an MCX market, what are you doing? You're buying and selling instruments. In the physical market, in a spot market, you're buying physical commodities. Both these markets are existing in parallel. Yeah, both markets are going together. But when a contract comes to an end, the day the contract ends, the contract will be settled at a price which is the spot price of that day. Yeah, so the spot price of the day when the contract comes to an end, yeah, that is the price at which the derivative contract will be settled. So both these markets, they exist in parallel, and the commodity markets are there for people to manage risk. So we talked about risk management and price discovery. These are the two pillars of a commodity exchange. And when you're talking about managing risk, you manage risk using a tool called hedging. And I'll explain hedging later. But the point here is that when you're hedging, you're putting one market against the other. You're pitting one market against the other. Spot market vis-a-vis the derivative market. So when you hedge, do you end up making money? No, you don't. When you hedge, do you lose money? No, you don't. By hedging, you're minimizing risk. What risk are you minimizing? By hedging, you minimize price risk. And hence, hedging is the main reason why commodity exchanges have been allowed to come into existence right across the world, and including in India. So when I'm buying an instrument, like if I'm buying a crude oil futures, or if I'm buying a cardamom futures contract, or if I'm buying a gold options contract, I'm buying in the future. If I'm buying something in the future, then that contract has to have an underline. So a potato contract, a potato futures contract will have potato as the underline. A gold futures contract will have gold as an underline. Yeah. So whenever you ask about a contract, you must say what contract is it and what date is the contract going to come to an end on. Yeah. So COVID-19, it has severely impacted our economy, disrupted global economy. Yeah. Back on a raw material supply chain, and in fact, new chains are being established right now. Yeah, COVID-19 has impacted on production and manufacturing. Okay, it has impacted on consumption and distribution. When did you all last buy a shirt or a pant? Yeah, or a sari for that matter for the ladies. When did you last buy a dress? Okay, the point of the matter is that COVID-19 has impacted consumption patterns. When did you go to a restaurant last? Okay, now this point I've already explained, the last one, interest rates, currency exchange rates, capital flows, all been impacted by COVID-19. But the reason I'm bringing this out right now is because when I'm talking about all these things, all these points that you see on the screen right now, they have impacted the spot prices of commodities. They have impacted the spot prices of commodities. And if I want to buy something in the future, then I need to understand what the spot price is. Only once I know what the spot price is, then I'll be able to have a reasonably good assessment of what the future price might be. Yeah. And hence COVID-19 has an impact on commodity prices from that point of view. Now, objectives of a commodity derivative market, one is risk management, the hedging, which I already discussed. Price discovery, yeah, is what you get because of a lot of people who are trading in the market. I'll show you a live market in a few minutes. Then the other thing is transactional efficiency. So you can sit at home on a laptop, on a mobile, you can buy the contracts. So there are a lot of people who are buying and selling contracts online. And I'll show you the line of the market right now in a few minutes. Okay. And when you buy, we know what it does. The minute you buy a contract, the margin money gets blocked in your account. And the information goes from your laptop, it goes to your broker, to the exchange, to the bank. Yeah. And all this is digitally linked. And by the way, this digital link has been going on for a very long time and nothing to do with with the COVID. It is there right from the time when the exchange was established in the year 2003. Since then, all this transactional efficiency is taking place because you can sit and trade. Automatically, money gets adjusted. Yeah, every day there's a margin money adjustment takes place, and all that happens automatically. Yeah, the transactional efficiency is happening. You can do it on your mobile as well, just by clicking, just like you're buying stocks, and many of you might be trading in the stock market. Now, other thing is this liquidity and savings in the long run. If I want a commodity in the month of December, and if I think price is going up, then I buy the commodity now and keep it till December because I need the commodity in December. I don't need it now. Now, by doing that, what happens? My money gets locked up. Then I have to look for a go down or a warehouse to park my goods, which I have purchased. But because if I'm buying a commodity, a contract, a December contract, so what happens is that right now I only pay a margin money, which is a small percentage of the value. The rest of the money I pay at the end of the contract. And at the end of the contract, I pay the money and I get the goods. Now, that's where the exchange comes in. Exchange guarantees the trade. That means when you buy something in the future, and when the contract comes to an end, you will get delivery at the date when the contract comes to an end. And that guarantee is given by the commodity exchange. Okay. And there's, of course, integration of all the markets. This integration of markets helps you to understand what the price is and what the price movements are going to be. Okay. So this is the objective of a commodity derivative market is risk management, price discovery, efficiency, transaction efficiency, liquidity, guarantee of trade, and integration of markets. Okay. Now here, this particular example, this particular chart will explain to you better what I mean by hedging and what I mean by risk. So you see, when you look at prices of commodities, they are very volatile. They keep moving up and down all the time. Okay, so price is moving up and down all the time, and there it says today. Can you see where it says today? Yeah, so that is now. Now, I'm not sure which direction the price will go. After today, the price by December might go right up there, or it might come right down there. If I'm somebody who wants to sell, I'm a seller, yeah, then I'm frightened that the price might fall. If I'm a buyer of the same commodity, then I'm frightened that the price might go up there. And hence that little this little triangle which has been formed is the risk. This is the risk. This is called the price risk. This is the risk I'm trying to overcome. And I do that by taking positions in the futures contract in such a manner that once I'm hedged, do I end up making a profit? No, I don't. Do I end up making a loss? No, I don't. So I'm only locked into the price, and I'm successfully mitigated my risk, my price risk. So in hedging, I don't make a profit, I don't make a loss. I am locked into the price. So what exactly is hedging? Hedging means I take an opposite position in the futures market, in the instrument market, by buying or selling a contract. I take an opposite position to the position in the physical market, which means that if I want to buy a physical commodity, I sell the contract now. If I want to sell a physical commodity, I buy the contract now. So I do exactly the opposite in the futures market and in the physical market. Yeah, always the hedger will always take an opposite position. Okay, so to opposite position to his current status. Now, what it does, it reduces or limits risk associated with unpredictable changes in price. And the objective behind this mechanism, the most important thing, is to offset a gain, a loss or a gain in one market, could be a physical market, with a gain in the other market, which is a futures market. So again, I come back to that previous slide. I showed you there are two markets, a spot market and a derivative market. Hedging is a mechanism where you take an opposite position in both the markets in such a manner that if you gain in one market, you lose in the other. That is what hedging is all about. And because you're gaining at one market and losing in the other, net, there's no profit, no loss. The idea of hedging is not to make a profit, but it is to manage risk. What risk? Price risk. So if I'm a manufacturer of a final product, then I'm not really bothered with the raw material costs going up or going down because I'm locked into the price. I can now focus on other things. Yeah, I can focus on the core activity of my business. So what is hedging? Taking a position in the futures market opposite to the position in the physical market. And I explained these 3 points earlier. And who is a hedger? You can see all these guys in the red here: corporates, farmers, and producers, and intermediaries, and importers, exporters. You also have foreign hedgers, EFPs we call them. Yeah, these are people who buy in India from sources. They source it in India and then they export it and sell it abroad, or they buy abroad and they import it into India and sell it in India. So there are some foreigners who do that. Yeah, foreign companies do that. Yeah, for example, in agriculture commodity, we have companies like Cargill, or we have Mercuria, and we have Vitol Group, and we have the ADM Group. All these groups are there, which buy here and sell abroad, or they sell commodities, they buy commodities abroad, bring it into India. But the point is, between that intermediate period, between the time they procure and the time they sell, during that little period, that's when the price could go out of hand. And hence they are, although they are foreigners, they can be hedgers, and they can also come and hedge in India. Yeah, so they can hedge on exchanges. We call them EFEs. We call them eligible foreign exporters. Yeah, entities. They call eligible foreign entities. So these are the people who are impacted by price movement, and they can come and hedge. So all these hedgers, their aim is not to make money. So who's making money? They're transferring the risk to the investor. Investor is trying to make money, but if you want to make money, then you have to take a risk, and higher the risk, higher the return, right? You know that high risk, high return, low risk, low return. So investors can be of different categories. They can be speculators and arbitragers, and they can be category 3 hedge funds, mutual funds. Mutual funds are allowed in the commodity markets, and there's a nice place to get a job. Portfolio management schemes are there. The services are there. So these are the people who are investors who don't want the commodity. They only want to make money on the price movement. Hedgers, they want to lock into the price. So it doesn't matter which direction the price moves. They will make no profit. Benefit of hedging: lock into prices, ensure better cash flow management, insurance against price risk because they're locked into the price. It doesn't matter. You're almost like an insurance. Better inventory management. Yeah. So you don't need a warehouse. You will just take delivery as and when you need it. Greater focus on core business activity. You don't need a very large procurement team. You don't have to. You just need a better treasury team, a smaller treasury team, rather than a very large procurement team, and then you can manage that. Yeah, so the benefits of hedging. Commodities traded on a commodity exchange. The commodity exchange, we have precious metals, we have gold and silver. We got different types of contracts. We got gold mini, silver mini, gold petal. The gold contract is a 1 kg contract. Gold mini is a 100-gram contract. Gold, we have futures and we have gold options as well. I'll talk on options in a little while. So we got silver, silver mini. Basically, the quantum of the size of the trade is smaller. Yeah, silver is a 30 kg contract. Yeah, so that is, you can see that this is a kilogram contract. We got a gold guinea contract, which is an 8-gram contract. Gold petal is a 1-gram contract. We got crude oil, natural gas. These are energy products. We have base metals like aluminium, brass, copper, lead, nickel, and zinc. Yeah, lots of these commodities are used by the automobile industry. The automobile industry uses, when you think about what goes into the making of a car, lots of base metals go into the making of the, don't look at the car as the body of the car, look at the auto components which go inside the engine of a car, many of them are, you find them here. Agri commodities, mentha, cardamom, cotton, crude palm oil, natural rubber. We got some others which are not here. Soya, yeah. So there are many commodities which are there. So the other, for gold, I think I've already explained, you've got different size contracts: a kilogram contract, a 100-gram contract, 8-gram contract, and a 1-gram contract. Why we have these different ranges of contracts is because we are trying to appeal to different strata of society. Now, and also a petal contract is a nice small 1-gram contract. If somebody wants to enter into a commodity market, that is the way to get into it. 1 gram gold is approximately 5,000 rupees at today's date. Okay, 10 grams is 50,000 rupees, assuming. We also have something called index futures, which we have just launched recently. Like you can trade on Nifty on a commodity on the stock exchange, or the BSE Sensex. Similarly, what exactly is Nifty and Sensex? It is an amalgamation of many different shares from different industries. So you have the cement stocks, and you have automobile stocks, and you have your FMCG stocks, and you have banking stocks, and so on. And so Nifty consists of a good representation of the economy by having shares from the different segments. Similarly, in the commodity exchange, we have launched the index futures on gold at the moment, on bullion right now, which is a amalgamation. We call it the bullion index futures, which is an amalgamation of gold and silver. So eventually, in a few days, in a few months' time, we'll come out with a metal index, and then we'll have the COMEX, which will be a mixture of all the commodities traded on the commodity exchanges. Now, this particular slide is basically telling you that prices of commodities are very volatile. By volatile, we mean the price keeps going up and down all the time. So you can see the little movements that take place when prices are going up and down. Okay. Now, a speculator or a trader will try and make money on these little movements. Every time it goes up and down, there's an opportunity for the trader to make money. And this movement of prices going up and down, and the entire, you can see the entire price can move upwards or downwards. This is a risk for the user or the consumer of a commodity. So a hedger takes a position once and he exits at the end. And at the end of the day, if he makes money on the futures, then he loses money on the spot. If he makes money on the spot, then he loses money on the futures. Yeah, and hence depending on whether you're a speculator or a hedger, your trading strategies will differ, because a hedger is not trading, he's hedging. A hedger is not trader, he's not a trader. He's trying to mitigate his risk, and he enters once and he exits at the other end. Whereas a speculator, he keeps going in and out all the time. Now here, I just want to tell you, maybe some of you might be new to this market. If I buy a contract now, then I can just actually take a sip of water and I can sell the same contract back. Now, the difference between the price at which I bought and the price at which I sold, that difference would be either my profit or my loss. Okay. So, and hence, what I have actually explained to you is something that you've learned in economics, called in microeconomics, perfect competition. We have come across a term called free entry, free exit. Yeah. And that is what it means. I can buy a contract, I can sell a contract. I can sell a contract, sell a contract, sell a contract, go for a walk, come back and buy the contract back and buy the contract back. I can keep doing this the entire day. I can do this right from 9 a.m. in the morning till 11:55 p.m. at night. Because commodity exchanges trade till 11:55 at night. Okay. All right, so you can see the volatility is there for crude oil and natural gas. This is for crude oil volatility is very volatile. And so is this the case with natural gas. Natural gas is used in fertilizer industry. It is used in the glass making industry. Natural gas is used as energy for in the auto sector. Yeah, so we can see, and crude oil, of course, has got lots of other uses. Even your tar for making the road comes from crude oil. You've got all kinds of gels and grease and what have you coming from the crude oil. You got diesel coming from there, kerosene coming from there, and you got all types of uses that crude oil can be put up to. In fact, if you're students right now, maybe in your spare time, you can just half a page of effort you can put in. You can say, hey, what are the uses of crude oil? And you'll be amazed as to what kind of uses crude oil can be put to. Yeah, so crude oil that India imports is in the raw form. It gets refined, and then we convert it into the fuel that you buy at petrol pumps. Okay. Now, settlement, when you talk about settlement, when a contract comes to an end, we settle the contract. Okay, so when you settle the contract, there are two types of settlement. One is called a daily settlement, and one is called a final settlement. Let's take the final settlement first. So if I have a contract that I've bought, suppose I buy the December contract, then what happens in December when the contract comes to an end? I can settle the contract by taking delivery. If I have sold the contract, then what happens in the month of December? I will be expected to give delivery of the goods. Yeah, so in the month of December. And if a contract is if I want to cash settle it, I can square up my position and cash settle it. So I brought in a new word here, square up. What is square up? I buy a contract, I have a sip of water, I sell a contract. What have I done? I've squared up my position. I sell a contract and I sell a contract and I sell a contract. Take a deep breath and I buy the contract back and I buy the contract back and I buy a contract back. So what have I done? I squared up all the three contracts. Now, what have the connection to your economics? Free entry, free exit. I can enter and exit that contract at will. Yeah. Okay. The difference between the price I bought the contract and sold the contract, or I sold the contract and I bought the contract back again, that difference will decide whether I made money or I've lost money. Who does this kind of transactions? The speculator does. Yeah. What does a hedger do? Hedger just buys the contracts, waits up to the end and takes delivery. Or a hedger, what else can he do? He can sell a contract and wait till the end and give delivery. So a farmer will sell a contract, wait till December, give delivery. A manufacturer who's dependent on the raw material, he'll buy a contract, wait till December, take delivery. Yeah. And there are certain contracts which are what we call cash settled contracts. That means there is no delivery in that. So for example, crude oil, I cannot take delivery of crude oil because if I take delivery, where will I keep it? And hence, there are certain contracts. By the nature of the contract, you have to read the contract to find out where. Daily settlement is that every time I buy a contract, I need to pay margin money. Margin money is approximately, let's assume it is 5% of the value of the contract. So if of the current value is blocked in the account. Day after tomorrow, the price goes down, then 5% of the new value is again calculated and blocked in my account. And this adjustment of the margin money is happening every single day. And that is what we call daily margin settlement or daily margin adjustment. The second kind of a transaction that takes place every day, if I buy something for 100 rupees today, and tomorrow the price goes up to 150, then I have made money. How much money have I made? I have made 50 rupees. So the 50 rupees will be paid to me in my account tomorrow. If tomorrow the price had gone, if I bought something at 100 and then tomorrow the price had gone down to 25, then I made a loss of 75. So the exchange will take 75 rupees from me tomorrow. So this daily settlement of the profit element in the contract is adjusted daily. It is done seamlessly. It is done digitally. It is done between you, your broker, the exchange, yeah, and a new entity which is called the clearing. There is something called a clearing corporation. So all the money adjustment, all the delivery, taking delivery, giving delivery, all the margin adjustments, everything that is happening digitally is happening in a subsidiary of the exchange called MCX CCL. It's called MCX Clearing Corporation, independent body. So it is almost like the accounting of all your trades are being done by the clearing. The clearing name is MCX Clearing Corporation. So that ComRisk, yeah, and that is your the ComRisk is where the commodities, once you deliver your commodities, it goes into a something called an it generates, the ComRisk generates an electronic warehouse receipt. It's done by, it's ComRisk is the company. So you can do a ComRisk, you can do a Google on ComRisk and you'll know what ComRisk is. So just to give you an idea, I buy a December contract. In the month of December, I have to give delivery. Come December, I go and give delivery at a warehouse which has been designated by the exchange as being of good quality. What do you mean by good quality warehouse? It is a warehouse which has been accredited by WDRA, Warehouse Development Regulatory Authority. So there's a Warehouse Development Regulatory Authority which makes sure that we have quality warehouses, and the exchanges will direct buyers and sellers to these warehouses where they can go and give delivery. Once delivery is made, they will get an electronic warehouse receipt. The receipt says that my goods are lying in the account in that particular warehouse. I take this receipt and give it to the exchange. The exchange will give it to the buyer. The buyer will then, against that receipt, take the goods. But we are moving very, very rapidly in this particular area. So these are negotiable receipts, which means that this receipt I can sell it to somebody else at a different price, of course, hopefully a better price. So there's going to be a something called a negotiable warehouse receipt, where you can negotiate these receipts. Yeah, and all this is happening at under the eyes of something called MCX CCL. Yeah, MCX CCL, MCX Clearing Corporation Limited, a separate entity, which is like the accounts department of an exchange. It's a totally independent body. Now, when you talk about commodity markets, you got a SEBI. Under that comes the exchanges. Yeah, SEBI is a regulator, remember, for both, for the stock exchange, for the commodity exchange. And in fact, commodity exchanges are today also called stock exchanges. BSE, NSE have got, you can trade on commodities on their exchange as well. On our exchange, on MCX, we are keeping it purely commodity. But in the future, you never know. We might also get into the stock markets. So then in that case, you might end up having 3 stock exchanges. But at the moment, we don't have any such ideas. We are only totally looking at commodities at the moment. We're focusing on commodities, and we have 95% of the market share of the commodity trade in India. And so we have the stock exchange like the MCX. Total in commodity sector, we have 5 commodity exchanges in India. MCX is the largest with 95% market share. These commodity exchanges, we have members. And if I want to trade, I'm a client of a member. Who is a member? All the broking firms are members. So if you think of any broking firms like Zerodha or Motilal Oswal or Religare or whichever broking firm that you can think of, they are members of the exchange, and you become a client of the member. And that is how the regulatory system is. So I, as a client, I'm trading with my account with the member, and the member is a member of the exchange, and the stock markets report into the SEBI. Yeah, so overall regulator is SEBI. Every contract that is designed by the exchange has to be vetted by SEBI. Okay, so SEBI oversees the entire commodity market, including the commodity derivative market. Okay, I have to tell you about the do's and don'ts. Okay, so when you talk about the do's and don'ts, just a moment, hang on. Yeah, so there are some things that I need to warn you about when we talk about do's and don'ts. Yeah, always trade through a registered member. Make sure that you do a KYC when you trade. Yeah, that means whoever trades on the commodity exchange, KYC has been done. So we want to make sure that the people who trade are of good character. Yeah. You have to upload your mobile numbers. Okay. So that every time a trade takes place, you get a message, just like in the stock market, brokers to upload your mobile number. Every time you trade, there's a unique client code generated. So you know that it is your transaction. You have to always, before you start trading, you have to insist on reading the risk disclosure document. Okay. Do not be influenced by indicative returns or promised returns. If someone tells you buy this and you'll make money, or hot tip or rumors or advertisements, don't be carried away by all that. Do not make payments in cash, because we are digital technology, everything happening seamlessly, electronically. Do not sign any DPs or furnish any security deposits. Do not pay any brokerage in excess of rates prescribed by the exchange. Yeah, so there's so every time you trade, there is a brokerage. That brokerage has been prescribed by the exchange, vetted by the regulator. So make sure that you don't pay any excess amount to your broker. There is something called dabba trading. Make sure that you understand what dabba trading is. It's illegal trading. People form groups, small groups of people. They trade amongst themselves. They want to bypass the legal system. They don't want to use the banking system. They don't want to use any other, any method by which that a track can be kept of your trades. And hence people trade using black money. They use bags full of money which are exchanged, and it's called dabba trading. Now, why I'm talking about this and why we want to inform you about that dabba trading, because it is criminal. It is a jailable offense. Okay, it's a jailable and criminal offense. Of course, because of demonetization, almost about 95% of dabba trading came to a halt. Okay, so a lot of the dabbas had the old notes, and hence they came to an end. But the point is, today you're studying, tomorrow you might be in employment, and the minute you're in employment, you may come across a situation where you may be doing some trading, which is what we call dabba trading. Learn to recognize it and learn to keep away from it. Options are, again, in one single word. Just a moment, I'm just going to close the window. I'm getting some noise. Yeah, so options, in one single word, options are derivatives. In two words, they are financial instruments. What are financial instruments? Three characteristics. You pay only a small amount of, one is you're buying something in the future, selling something in the future today at the price that you want to trade at. But in options, you're trading at a strike price. Okay. And the second thing is that it involves a small amount of money. We call that a premium. You pay a small premium to take a position. And the options, again, are all settled on the contract date in the future. Now, the other thing that you need to understand about options, the other thing that you need to understand about options is that there are two types of options: a call option and a put option. Call option is, I pay a little bit of money now and I buy a right to buy something in the future. That's called a call option. So I pay you 10 rupees now and I buy this right to buy something from you at 100 rupees per kilogram in the month of December. That little bit of money that I pay now is called a premium, and I have a right to buy something at 100 rupees. The 100 rupees becomes a strike price. And the buyer of this right, so we call it buyer of a call option, who has bought the right, he has a right but no obligation, which means in December, if he finds that the same commodity is available cheaply in the market, then he goes to the market and buys it cheap. And he walks away from the deal and he has lost the premium that he has paid. The other side, the seller of a call option, he is the person who accepts the premium, and now he is obligated to sell in the month of December if and only if the buyer decides to exercise his right to sell. So sorry, buyer exercises his right to buy. So if he exercises his right to buy, the seller of a call option will be obligated to sell. But the buyer of a call option is under no obligation to buy. He only has a right to buy, and for that right, he has paid a premium. In a put option, I pay a little bit of money now, and you think of it from a farmer's point of view. So a farmer, he's frightened that he may not get the good price. So a farmer might pay a little bit of money now called a premium, and he buys a right to sell at a pre-agreed price in the month of December. But he has no obligation to sell, which means that if he can find a better price in the market in the month of December, he will be happy to sell it at a higher price. However, if the market prices collapse because of COVID-19, then he will exercise his right to sell, and the seller of a put option will be obligated to buy. He will be obligated because he has accepted the premium. So he has collected the premium. So in options, there are only 4 positions. There's a call option buyer and a call option seller. There's a put option buyer and a put option seller. That is all there is. Okay. Now, in options, there's some terminology that you need to understand. There's something called options price. Options price is the premium that you pay to buy the right. Right to buy in a call option or right to sell in a put option. All options have an expiry date, which is the contract date. There's a strike price. I pay you 10 rupees now to buy the right to buy something at 300 rupees in December. 300 becomes a strike price. I pay you 500 rupees now and I buy the right to sell something to you in the month of January next year at a strike price of 35,000. 35,000 is a strike price. So the price at which the contract has taken place. For buying that right to buy or right to sell, that is a strike price at which the trade is taking place. Open interest basically tells you how many people are trading at that particular strike price. And there's something called in the money and out of the money. Yeah, I buy a right to buy something from you at 100 rupees in the month of December. But those same goods are available today in the market at 500 rupees. I have a right to buy at 100 rupees. So I am 400 rupees in the money. Although the contract will be executed right at the end, it will be settled right at the end of the contract. But as of now, I am already in the money. How much in the money? 400 rupees in the money. I have a right to buy something from you at 100 rupees in December, but the market price today is already 50 rupees. Will I exercise my right? I will not. I am out of the money. How much out of the money am I? 50 rupees out of the money. I will not exercise my right because I will be happy to buy in the open market at the going exchange price. And hence, between today and the date on the contract expires, the price, I might be in the money, out of the money, depending on the direction in which the prices move. And intrinsic value is the actual money in money terms. How much am I in the money or how much am I out of the money? That is what is called the intrinsic value. So on a commodity exchange like ours, we got gold, silver, crude oil, copper, and zinc contracts. We have all these contracts. These are all what these are called options on futures. These are the contracts we have. In addition to this, we have a mini contract in gold and a mini contract in silver as well. These contracts, they are all options on futures. At the time when the contract expires, these contracts will convert into futures contracts. So at present, these are the only contracts we have. All contracts, whether they're futures contracts or options contracts, they are there on our website. Why are they there on our website? Because they are the products. Just like a car manufacturer has got a car photograph on his website, similarly, on commodity exchanges, the product of a commodity exchange is the contract. There are 86 exchanges worldwide. All of them have websites. Please go and check out their products. So if you're checking out their products, what is their product? Contracts. They call them contract specification. Yeah, so look at that. You can trade. You can trade on futures contracts on mobiles as well. Okay. The important points: possible commodity price risks. Price risk because of various things, because of weather, because of rainfall, less rainfall, because of infestation of different kinds of worms on agriculture commodities. It could be because of politics, geopolitics. You can have, because of mine closures. Some mines have closed down, so that can be possible commodity price risk. It could be a strike somewhere. It could be risks because of government imposition of some duty structures or banning some imports of some commodities or export to certain countries. How do you differentiate between hedging and speculation? A hedger is somebody who is connected with the physical commodity. He will eventually, at the end of the contract, either give delivery or he will take delivery. Speculation, he's only looking at the money movement and he's trying to make money. He doesn't want the commodity. Benefits of hedging, price discovery, of course, is happening because of exchange. Benefits of hedging is that you're locked into the price. You're able to, focus more on the business angle of your business rather than trying to find out the price at which you will procure the commodity or the price at which you will sell the commodity. So you are more focused on risk management, and hence the benefit of hedging. It's because of this that the commodity exchanges have been allowed to come into existence. We also call it price risk management. Daily and final settlements. When you trade on commodity exchanges, there is something called MCX CCL, which is settling the contracts on a day-to-day basis. Yeah, and also the final settlement of every contract is also done by the clearing corporation. Dabba trading is illegal. Yeah, make sure that you understand how to recognize it and you trade on that accordingly. You make sure that you will always make sure you keep away from the dabba trading. Okay. Sorry about that. Okay. So with this, I'm going to show you a live market in a few minutes. Okay. So then we'll take questions. I just need to take a photograph. So let me just choose something and take a photograph of that because I need to show it. Okay. Right. I'm going to stop this presentation of mine for a few minutes, and I'm bringing in another presentation in a few. I'm going to show you a live market. Can someone tell me whether you can see the screen right now?
Sir, no, sir.
No, not yet. Okay, just a moment. Okay, can you see the screen now?
Yes, it's good, sir.
Okay.
Able to see.
Okay. Now, what I'm showing you right now is live trading taking place of a commodity futures. Okay. Now, can you see the commodities on the left side? It says copper. There are 3 copper contracts, 3 crude oil contracts, 3 gold contracts, 3 cotton contracts. Now, I've created this. I can actually create. I can add anything I wish. I can actually go there and I can add something else. Let me add something. So do you have an idea? I can add aluminium there. Yeah, can you see aluminium I've added? And I've got so many contracts, so I can add whichever contract I wish. Okay, so I've added there we go. We got an aluminium contract added right at the bottom there. The point of the matter is this screen can be adjusted to my requirements. Anyone can do that. Okay. Number 2, this screen that I've created, I've done it because I want you to understand that this basically is not done at random. There is a copper is coming from the base metal segment, crude oil is coming from the energy segment, gold is coming from the bullion segment, cotton is coming from the agri segment. Yeah. Every time you see these lights changing, these are the prices. These are the prices at which the trade is taking place. What is this price? So let's look at gold. It's trading at 51,923. Then it's trading at 52,078, 52,219. You can see the different prices for gold. Why are the different prices? Because first one is 5th of October contract, 4th of December contract, 5th of February contract. So what are these prices? These are the prices that people think is going to be the price on those dates. So if you look at the price of 52,077, this is the price, or 52,094. This is the price that people think is going to be the price on the 4th of December. Okay. So now you should understand what the derivatives are. Derivatives allow you to buy something in the future. How far in the future? You can see the date. So every contract has a date, and the price at which the trading is taking place is the price that people think is going to be the price on that date. Okay. So what is today's price? So if I want to know today's price, I can just go down here and you can see here it says UL. This is today's price. Some of them are not populated yet. So for example, copper price is not there. I think there's a cotton prices there, and this, I think one more price, this 22815 is the crude oil price. The other one, the copper and gold prices are not yet there. The spot price is not there. The reason being, because these prices of copper and gold, they're coming from international markets, and the vendor who gives us the spot price has not yet given us. So in another hour or so, that price will be populated. So the person who is trading can see the market. He can see the spot price, and he can make a decision as to the price at which he wishes to trade. So every contract has got two identifiers. You have a date on which the contract will expire and the underlying. Yeah, so underlying is copper. This is the date on which the contract will expire. These are the prices. And similarly, let's take one more. I'm just going to highlight gold. So I've got gold highlighted. So if I press here, I can get the contract for that gold contract which I've highlighted. So it's a 1 kg contract. I know when I know it's a 0.995 pure gold. So I know the quality of the contract. I know the price range within which the trading is going to take place today. So a lot of indicators are here for people who trade. The other thing I want to show you is we can show the depth of the market. So for example, for the same contract, you can see now the depth of the market. At this moment, there are 464 kgs people are willing to buy at different prices. And there are 360 kgs people are willing to sell at different prices. The person who's selling at the lowest price he's at the top. The one who's selling at the lowest price at the top, the one who wants to more money for his goods, he's at the bottom. The person who's buying is in blue. The person who wishes to pay the highest to buy, he has a priority, he's at the top. The one who wants to pay less money, he's at the bottom of the, yeah. So this is a live market. The people where they're trading right across India. The traders right now are sitting right from Kashmir to Kanyakumari, anywhere from Bhuj to Andaman Islands. As long as you've got a connectivity through a broker, then you have a screen like this and you can trade. You can buy and sell. What are you buying and what are you selling? You're buying and selling a contract. If I buy a contract now, when can I sell it? I can take a deep breath and sell it. The difference between the price at which I enter and exit would be my profit or my loss. Every time you see a little bit of red there, it means the price has gone down compared to the last trade. Every time you see a blue, it means the price has gone up compared to the last trade. Okay, so you can see the last traded price there. Yeah? So it tells you last traded price, tells you the open interest. So basically the point here is on a trading terminal such as this, which is today allowed, or you can see a similar kind of a thing on a mobile as well. Okay, you don't need to have a laptop. You can even trade sitting on a mobile. But on a laptop, you can have a better picture of what is happening here. Okay. So this is what I wanted to show you, live market. So I'm going to stop sharing this particular screen, and we will take questions now. Okay. Can we take questions?
Yes, sir. We have a question from Mr. From Parvati Karun. Sir,
Okay.
you said something about weather trading. Could you explain something about it? It's the first time I'm sharing something about weather trading.
Okay. Couple of things here. We don't have weather trading here in India. So they're at the moment they're at the Chicago Climate Exchange, European Climate Exchange, and the Tokyo Climate Exchange. All right. What are you buying? You're buying weather contracts. I'm buying temperature in the future. Okay. Now, why are these contracts available? The primary reason is meant for people to manage risk. What risk? Risk to their business. So whenever temperature has an impact on your business, then you can manage your risk, which is because of temperature, by buying and selling contracts. Now, who gets impacted by temperature? Which business gets impacted by temperature? So it could be, because these contracts are mainly there in the Western Hemisphere, in the developed markets. There, what happens is a lot of electricity generating and electricity distributing companies, they are impacted by temperature. For example, if the weather is very cold in the Northern Hemisphere, then people use more electricity, agriculture, the farmers. So there can be a 3 degrees variation from the normal temperature can account for a 5% drop in output of their agricultural commodity. So a farmer might also want to hedge in temperature, so that if he makes a loss because of temperature moving in a wrong direction, he ends up making a profit on the temperature contract. He makes loss on the output, he makes money on the contract. So in hedging, the aim is not about making money on the contract. The aim is to nullify the loss in the physical market by making a gain on the futures market. But you don't know which direction the temperature will go. So if you make a loss on the temperature side, then you make a gain on the, you will have a better output on the, in the agriculture segment, in the physical segment. And hence, when you're buying, what are you buying? You're buying temperature. You're buying, they call it HDD days. You're buying temperature. So when you buy at a particular degrees Fahrenheit, then the exchange will settle the contract based on what the actual temperature on that particular contract expiry day is. And you might make a money on that temperature difference between the temperature, the price at which you have entered, the temperature at which you have bought the contract, and the temperature at which you have settled the contract. So the difference between the two will either make money for you or lose money. But the aim here is not to speculate on the temperature, but to hedge your risk using that temperature. Okay. So in India, we are doing a lot of research. About 5 years ago, Arun Jaitley was he was a finance minister. He actually made a statement saying that in India, we will allow weather derivatives. Okay. So a lot of work is going on in India, but it is not on temperature. We're doing work on rainfall, because for us, rainfall is more important than the temperature. Okay. Rainfall does have a much more impact on the agriculture segment than does temperature. I'm not saying temperature does not have an impact, but rainfall does have a very severe impact on us. And hence, there's a lot of work going on. Even at my exchange, we're doing a lot of work on agriculture, because every time you want to launch and design a contract, a lot of work has to go on at the back end. Yeah? So there's some work going on there. The other one is on the, I think, related to weather is the one on freight. Now, freight is where I can block space on a ship, which will sail on a particular date. So I can buy that space. If I buy that space early, it's cheap. If I buy it last minute, it's expensive. It is something similar to buying before the lockdowns, buying seats on airlines. Yeah, if I want to travel tonight, then I end up paying a higher price. If I had booked the seat 3 months earlier, I would have paid a lower price. And the same logic applies to freight. On the freight contract, there are 3 variables. One is the route that you take. That means it would be from, let's say, from Visakhapatnam to, say, Kolkata. So that'd be a route. There'll be another route, Visakhapatnam to Sydney. So you'll have a different route. So you'll have 3 variables. One is the route. One will be the type of ship. Is it a tanker or is it a freight, carrying a cargo? Yeah, dry. So you call it dry or wet freight. So there'll be type of ship. Okay. And the third one is, of course, the date of the contract. So these are the 3 different variables which will come into play when you're trading on freight. And these contracts are already there on the Baltic exchange. So people are already hedging on that. So any more questions?
I think, sir, we will end the session. A lot of questions are coming up. I think they can get back to you if you can share your email ID, or they have any doubts. I think they can get back to you.
Right. Sure.
Yes. So it's a long time from 11 o'clock to 12. It's almost 12:45. Thank you very much, sir. And I think you have demystified commodity contracts and commodity derivatives today. Thank you very much, and hope all the students out there, working professionals and others who have joined in would have found this very useful. It's just a tip of an iceberg, I believe, and a lot more reading should go into, at least for students and others, to understand more about this. But it's an exciting space to be there for the finance professionals. Yes. And the students would definitely be benefited, I believe. Thank you very much, sir, for joining in.
You're welcome.
And, all the participants will be posting the feedback link right now. And you can just send us the feedback, And you can just check the chat box. We've already posted it. So please do the feedback. And once again, thank you very much, sir. Thanks a lot.
Thank you. Thank you. Please forward me the feedback. Yeah, I will reply the
Sure,
feedback.
sir. I'll be
Thank you
sharing
very
the
much.
link with you, and we'll be in touch again.
Absolutely. Yeah. Sure.
Fantastic programs from your side, sir.
Great. Thank you.
Thanks a lot.
Yeah, participants, we are open for another 5-10 minutes. You can post your feedback in the link which is provided in the chat box.